Hello everyone, welcome to my presentation about three exciting topics from the second half of the FinTech investing and trading course. My name is Tom de Guiter and today I will be discussing a technical analysis of Bitcoin, the rise of the decentralized finance or DeFi, and the risk management in investment strategies. I choose these topics because they represent a critical aspect of the modern trading and investing, and they highlight the interplay between technology and finance. So let's dive in. First of all, the technical analysis of Bitcoin. Our first topic is throughout technical analysis of Bitcoin. Bitcoin has been highly volatile asset, making it fascinating subject for technical analysis. So first of all, the time frame section. For this analysis, I chose for a daily time frame. This time frame provides a balance between capturing significant trends and avoiding excessive noise. Choosing the right time frame is crucial because it determines the kind of trends and signals you observe. For Bitcoin, which can exhibit rapid price movements, a daily time frame helps in capturing medium-term trends effectively. So we have the risk per trade, the position size, the entry and the stop loss. So to manage risk, we use a rule of the risking 1% of our portfolio trade, which is in this case $100. Given the volatility of Bitcoin, we set a stop loss on 5% below the entry price to ensure we don't lose more than $100 on one single trade. So for example, in this case we have a $10,000 portfolio. So the position size calculation will be as follow. We have the amount to risk per trade is $100. The distance to stop loss is 5%. So the position size is $100 divided by 5%. So that's $2,000. Wow. Then we have the trade direction. Based on recent trends and market conditions, we take a long position expecting the price to rise. A short position expects to make a price go low. So the entry price will enter a trade at $30,000. Where we observe a support level, and this support level are critical because they indicate a price level where a downtrend can be expected to pass due to a concentration of demand. So then we have the exit price, and our target exit price is $35,000 based on the next resistance level. And these resistance levels are the opposite of support level and indicate when a price rise may pass due to a concentration of selling interest. And then we have the stop loss level. The stop loss is set at 28,500, and that's 5% below our entry price. And a well-placed stop loss is essential for protecting your portfolio from significant losses. So it's stop when the price goes below this point. Then the explanation of taking the trade. The decision to enter on 30,000 is based on historical support levels and moving average, just indicating a potential upward trend. So moving average helps smooth out the price data to identify the direction of the trend. So then we have the advanced TA application. We use tools like the relative strength index, the moving average to confirm our entry point. Currently the RSI is at 40, suggesting it's not overbought, and the MACD shows a bullish crossover, indicating a potential upward momentum. So the RSI, or relative strength index, is a momentum oscillator that measures the speeds of a change of price movements. So it oscillated between 0 and 100 and is typically used to identify overbought or oversold condition in the market. So an RSI below 30 suggests that the assets may be oversold, and RSI above 70 suggests that it may be overbought. So then we have the MACD, or moving average convergence divergence. And it's a trend of following momentum, and the indicator shows the relationship between two moving average and its security price. So the MACD is calculated by subtracting 26 period of EMA, exponential moving average, from the 12 period, and the EMA, the 9-day EMA of the MACD is called the signal line. It's then plotted on the top of the MACD, functioning as like a trigger for buy and sell signals. By integrating these two factors, we aim to optimize our entry and exit points, managing risk effectively. So this comprehensive approach of technical analysis helps us make informed decisions and increase our the probability of success for a trade. Now we have the second topic, the rise of decentralized finance, or DeFi. And this second topic is DeFi is transforming the financial industry by providing decentralized alternatives to the traditional financial services using blockchain technology. So DeFi refers to a financial system that operates without traditional intermediaries like banks, brokers, that kind of things. And it uses like smart contracts on blockchain networks like Ethereum to execute transactions. So DeFi aims on to create an open, permissionless and transparent financial system that's accessible to everyone with an internet connection. So unlike the traditional financial systems that are centralized and controlled by institutions, DeFi leverage blockchain technology to decentralize financial activities and eliminate intermediaries. So the key components of DeFi, platforms like Uniswap, SushiSwap allow users to trade cryptocurrencies directly with each other without intermediaries. So these exchanges use automated market makers to facilitate trades, which rely on liquidity pools provided by users. So the control is in our own hands. It's a traditional exchange. In a traditional exchange, trades are matched by a central book order managed by the exchange. In contrast, DEX use liquidity pools where users contribute pairs of tokens, enabling trading through algorithms that adjust prices based on the supply and demand. So the centralized model exchanges security and reduces the risk of hacks associated with centralized exchanges. So then we have the lending platforms and protocols like Aave and Compound enable users to lend and borrow cryptocurrencies, earning interest or gaining access to liquidity that they wouldn't have. So these platforms use smart contracts to automate the lending process, ensuring security and transparency. So in DeFi lending, users can deposit their crypto assets in a lending pool and earn interest based on demand for loans, of course. So borrowers can access these assets by providing collateral, often exceeding on the loan amount of to migrate the risk of default. So interest rates are dynamically adjusted based on the supply of demand, creating an efficient market for loans and deposits. So then we have stablecoins. Cryptocurrencies like DAI or USDC are patched with to the value of fiat currencies, so the currencies we use with banks, providing stability and volatile crypto market. Stablecoins are essential in DeFi as they provide a safe haven of a unit of account. So it's like a secure base. Stablecoins can be classified into three categories based on their underlying mechanism: fiat centralized, collateralized, crypto collateralized, and algorithm. So fiat Collateralized stablecoins are backed by reserves of fiat currencies, such as US dollars or the euro. Crypto collateralized stablecoins use cryptocurrency as a collateral, like Bitcoin, while algorithm stablecoins rely on the algorithms to manage supply and demand to maintain a stable value. So the advantage of DeFi, like anyone with internet connection can access the DeFi services, making financial services more inclusive. This is especially important in regions with undeveloped financial infrastructure. Then it's more transparent, and it's also more efficient because of the smart contracts. They automate process, reducing the need of manual intervention and lowering cost. So this automation leads to faster transactions and sometimes lower fees. So then we have the DeFi, the conclusion of DeFi. It's revolutionizing the financial industry by providing decentralized and transparent and also more efficient alternatives to traditional financial services. However, it also comes with a risk that need to be carefully managed. As the DeFi continues to evolve, it will be interesting to see how it integrates with the traditional finance and the regular frameworks that they merge with. So then we have the third topic. It's about the risk management in investment strategies. And the final topic is a crucial component for any trader or investor. And I think for me, maybe the most important thing I learned with the trading minor, because it's not something you really read on the internet, but something you learn by doing it. So first up, we have the diversification. And diversifying investments across different assets classes reduce the exposure to any single asset risk. So this means balancing your portfolio with stocks, bonds, commodities, and perhaps even cryptocurrency. So it's about not betting all your money on one horse. It's a fundamental principle in risk management, and by spreading your investments across different assets, classes, or sectors, you reduce the impact of any asset performing poorly and making a giant loss. Then we have position sizing, determining the appropriate size for each trade of an investment is vital. As mentioned earlier, risking a small percentage of your portfolio trade helps by managing potential losses, making that not too big in one time. So position sizing involves calculating the amount of capital to allocate to each trade based on your risk tolerance and the volatility of the asset. So for instance, in like a volatile market like cryptocurrency, you might allocate a smaller portion of your portfolio to manage the higher risk. While in a more stable market like bonds, you might allocate a larger position. Then we have stop loss orders. And implementing a stop loss order prevents the excessive loss by automatically selling an asset when it reaches a predetermined price. So this technique is essential for disciplined trading and make sure you doesn't lose a lot of money overnight when you're not actively looking at the prices. Then we have hedging, using financial instruments like options of future contracts can hedge your against potential losses in your portfolio. Hedging can protect against adverse price movements and stabilize return. So hedging is a strategy used by to offset potential losses in one investment by taking the opposite position in a related asset. So, for instance, if you hold like a large position in your stock, you can buy put options to hedge against a decline in the stock price. So this way, if stock price falls, the gains from the put options can offset the losses from the stock, providing a more stable overall return. So then we have continuous monitoring, and continuous monitoring ensures you that an investment strategy remains aligned with your goals and your risk tolerance. So market conditions and personal circumstances can change. So it's important to periodically, so every now and then, review your portfolio and make the adjustments as needed. So rebalancing involves selling overperforming assets or buying underperforming ones to maintain your target asset association. So then we have like I said, this like an important thing for me because now we get to the psychological aspects, and that's I think something you don't learn, but you learn by doing it and not learn by reading about it. Now managing your emotions is crucial in trading and investing. So fear and greed can lead to poor decision making, and developing a disciplined approach and sticking to your risk management plan is essential. So the psychological aspect of this of investing cannot be overstated. Emotional decision driven by fear or greed can, like I said, lead to significant losses. For instance, in panic selling during a market downturn can lock in losses, while chasing after rapidly stock can lead to buying inflated prices. So you can lose a lot of money by this, and you should stick to your plan. And if something goes wrong, it goes wrong. If something goes really great, it goes really great. And you can always adjust, but it's something to get in mind. You have to stick to your plan. So the overall conclusion. Thank you for watching my presentation. We have explored the technical analysis of Bitcoin, the risk of decentralized finance, and the crucial risk management strategies. So these topics highlight the importance of leveraging technology and sound practices in modern trading. So if you have any questions or comments, feel free to reach out. And don't forget to check the description for the references and further reading. Have a great day, and thank you.